If I were forced to name the single most important chart in this environment, I would not begin with unemployment. I would not begin with GDP. I would not begin with the latest press release from the central bank. I would begin with valuation, because valuation is where fantasy leaves fingerprints, and the fingerprints are all over this market. A great many people are still trying to answer the wrong question. They want to know why the market has not crashed yet, as if the absence of a crash were somehow proof that the danger has been exaggerated. I have no interest in that sort of comfort. The market can stay irrational for a long time. The more useful question is different. What kind of world has to exist to justify these prices? And how fragile is that world? I have spent most of my life respecting the relationship between price and reality. That does not mean I expect price to behave perfectly every day. It means I know that when price begins floating far above reality, some support has to be carrying that gap. If the support is temporary, the gap becomes dangerous. If the support is expensive, the gap becomes even more dangerous. That is exactly where I think we are now. Take the total value of publicly traded companies in the United States and compare it with the productive output of the economy that is supposed to support them. People call that the Buffett indicator. The name is flattering, but the only thing that matters is the ratio itself. If the market is worth about $66 trillion and the economy is producing around $30 trillion, the ratio is roughly 220%. That is not a normal reading. It is not even modestly stretched. It is extremely stretched. Before the dot-com collapse, something around 115% was already enough to raise serious concern. Today, we are in a realm far beyond that. To hear people speak calmly about it, you would think the number meant almost nothing. I do not think it means almost nothing. I think it means the market is sitting in a place where optimism has become very expensive. The same story appears if you look at earnings multiples. Historically, a broad market trading around 15 or 16 times earnings would not be considered bizarre. There is room for movement around that. A market can trade richer for a while during optimism, but once you move into the high 20s while the largest companies are trading at levels far above, even that, you are no longer looking at ordinary optimism. You are looking at a system that is pricing a very generous future. Nvidia above 50 times earnings, Amazon in the 30s, Microsoft in the mid to high 30s, Tesla in valuation territory so stretched that conventional language almost stops being useful. Those are not the sorts of prices you pay when you are buying safety. Those are the sorts of prices you pay when you are willing to reward hope at an extraordinary premium. Now, I want to be fair. Valuation alone is not timing. It does not tell you the week or even the year that the break must begin. That is why I do not use overvaluation as a countdown clock. I use it as a warning about the distance between the market and the productive base underneath it. And when that distance becomes large, I become very interested in the supports carrying it. That is the next step of the analysis, because a market like this does not remain elevated by magic. It remains elevated because forces are still feeding confidence. I see two large forces doing most of the visible work. The first is continuing fiscal support disguised as ordinary government behavior. The second is inflation and dollar weakness flattering nominal growth. Let us begin with the first one. A great many people convinced themselves that stimulus ended when the obvious checks stopped. That was far too simple. Governments do not need to announce support in bright letters for support to remain active. If the state collects around $5 trillion and spends closer to $7 trillion, the gap is not abstract. It is real money moving through the bloodstream. That spending shows up in contracts, in subsidies, in transfer channels, in tax treatment, in industry support, in wages, in government, adjacent demand. in the simple fact that more dollars are still entering the system than the headlines are willing to describe plainly. That matters because corporate earnings do not require healthy private demand alone, if public deficits are still padding the environment. Investors then look at revenue numbers and say the economy is more resilient than feared. What they are often really seeing is resilience purchased with continuing fiscal excess. That is a very different thing. It is the difference between organic strength and supported appearance. The support can work for a while. It comes with a bill. The debt burden is already enormous. Around $38 trillion in national debt. Over $1 trillion a year in interest costs. That is not the sort of support beam I call permanent. It is the sort of beam that says the delay itself is becoming part of the danger. The system is buying time with increasingly heavy obligations that can sustain confidence for longer than the public expects. It can also make the eventual reckoning harsher. Now let us move to the second beam, inflation and dollar weakness. This is one of the most misunderstood forces in the entire market today. The average household experiences inflation as pain. Rent is higher, food is higher, insurance is higher, the monthly budget tightens. That is all true. What many people fail to appreciate is how inflation can flatter the market at the same time it hurts the public. If the dollar weakens and nominal prices keep rising, corporate revenue can look stronger, even without dramatic real improvement. Companies can report growth because the measuring stick itself is losing purchasing power. The public hears growth. The market pays for growth. Meanwhile, the quality of the growth is much less impressive than the headline suggests. That is why I say inflation can wear the costume of growth. Wall Street understands that very well. If nominal earnings hold up, many investors stop asking whether the earnings were supported by real productive strength or simply by a monetary environment that made every number look larger. That is how elevated valuations survive longer than they should. There is another layer that matters just as much. Inflation tends to favor people who borrowed wisely to buy assets. That is one of the least pleasant but most reliable truths in the whole machine. If you borrowed when money was cheap and bought appreciating assets, inflation can make the debt easier to repay in real terms while lifting the nominal value of the things you own. The worker experiences inflation through rising costs. The leveraged owner often experiences it through debt erosion and asset support. That is why I say inflation is selective. It hurts nearly everyone emotionally. It does not reward and punish everyone in the same financial way. The worker becomes weaker. The owner, if he is positioned correctly, may become stronger. That dynamic keeps the market from breaking as quickly as ordinary people expect. The public sees pain and asks why the market is still rising. The answer is that the groups influencing the market are not receiving the same transmission that households receive. Their balance sheets can still look supported even while ordinary life becomes more strained. Now, this still does not answer the deeper question. Why do stretched markets stay stretched so long? The answer, as it often is, comes back to confidence. Confidence is what allows weak structures to survive past the point where logic first expected them to fail. I think of it like a bridge. A bridge does not give way the instant the first crack becomes visible. It gives way after enough people have crossed it enough times to start believing the crack no longer matters. That is exactly how markets behave in these periods. The more often the market survives bad news, the more people start believing the market is immune to the bad news. That is how late cycle confidence becomes self-reinforcing, until it does not. If you want to understand where the confidence is still coming from, you have to look at the consumer, the labor market, and faith in policy rescue. Start with the consumer. As long as consumers keep spending, many investors will keep telling themselves that the system is healthy enough. I do not read spending that way. I ask what is financing the spending. If it is being financed by rising real strength, that is encouraging. If it is being financed by weak savings and rising debt, that is not health. That is delay. The problem in the current market is that too much of the demand has the odor of borrowed endurance. Credit card balances are huge. Savings rates have been thin. Households have spent years trying to preserve a standard of life whose cost base has moved faster than their true purchasing power. That can keep nominal activity alive. It does not mean the foundation is sound. Then there is the labor market. People still talk about employment as though it were a wall of steel. I think that is generous. Employment is a lagging variable. It often looks strongest right before deterioration becomes obvious. Hiring can cool. Layoffs can spread. Hours can soften. Yet the public continues using yesterday's labor strength as if it were today's proof of stability. That is a serious mistake. A labor market can be late before it looks weak. If people understand that, they stop treating current employment headlines as a reason to dismiss all the strain underneath the system. Then comes policy faith. This may be the most emotionally powerful support of all. In earlier cycles, when things became unstable, lower rates and fresh liquidity often helped restore confidence. Markets learn the reflex. Trouble appears. Policymakers respond. The floor appears. Investors have been trained by memory to trust that sequence. The trouble is that reflex can outlive the conditions that made it effective. Consumers are already stretched. Debt is already high. The cost of living has already done damage. Lower rates may help on the edges, but they may not heal a system whose main problem is not simply the price of credit. Sometimes the system is over-leveraged, overvalued, and too dependent on weak quality demand. In that environment, policy can delay pain. It may not remove it. That brings us to the part I think most people still misunderstand. The delay itself becomes the danger. People treat delay like proof. If it has not broken yet, maybe it will not break. If it has survived this long, maybe the pessimists were wrong. I do not reason that way. I think delay allows excess to become more rooted. The longer valuations stay stretched, the more leverage gathers around them. The longer inflation disguises itself as healthy nominal growth, the more people confuse appearance with strength. The longer consumers use debt to preserve spending, the more violent the adjustment can become when that spending slows. The longer the labor market lags, the more surprising the deterioration feels when it finally becomes obvious. And the longer the market refuses to crack, the more loyal people become to the illusion that it is somehow stronger than feared. That is why I say the delayed correction is often more dangerous than an earlier one. An early correction clears excess sooner. A delayed correction lets complacency, leverage, and fantasy deepen before they are challenged. That makes the eventual break both more painful and more emotionally shocking. Most market breaks do not begin with the single worst piece of news imaginable. They begin when one event arrives in a context where confidence has grown too thin to absorb it. That event can vary: a bankruptcy, a credit issue, a policy mistake. A major miss by a company people assumed was untouchable. A fracture in a supposedly safe area. The exact trigger matters less than the condition of the bridge when the trigger arrives. If the bridge is already stretched, numb, and held together by expensive temporary supports, then one final blow is enough. That is when the market seems to break all at once. People call the collapse sudden. The buildup was anything but sudden. The buildup was tolerated. That is why I do not find comfort in a market that survives too many warnings. I find instruction. The survival tells me where the support beams still are. It tells me what investors are still choosing to believe. It tells me which pieces of the structure are carrying too much emotional weight. Once I know that, I do not need to predict the exact date of the correction. I only need to remain honest about the terms of the delay. The wise investor does not measure risk by the mood of the crowd. He measures risk by the hidden cost of the mood. Right now, I see a market supported by large deficits, inflation, flattered earnings, indebted consumers, delayed labor weakness, and stale faith in rescue. That is a real structure. It is not a healthy one. So what should a rational person do? First, stop borrowing the crowd's calm. The crowd is not paid to protect you. Second, study liquidity and quality. Not slogans, not mood. Quality of business, quality of balance sheet, quality of demand, quality of cash flow. Third, ask what in your own plan depends on continuing optimism. If your plan requires the market to keep being praised by people who are ignoring valuation, then your plan is already too fragile. Fourth, remember that late cycle numbness is not strength. It is fatigue. Markets can hear bad news so many times that bad news seems to stop mattering. That is not resilience. It is exhaustion before a break. That is why I would rather lose the illusion early and keep my judgment than keep the illusion longer and lose my discipline with it. There is one final point people need to hear. Time does not automatically heal structural weakness. Sometimes it worsens it. That is why the sentence, "If it has not crashed yet, maybe it never will," is one of the most dangerous sentences in finance. Weakness does not evaporate because the calendar turned. Leverage can deepen with time. Complacency can deepen with time. Public faith can deepen with time. That is why time can be the mechanism by which risk grows, not disappears. I do not panic over that. I respect it. Panic is useless. Respect is valuable. Respect studies the bridge. Respect studies the strain. Respect studies what the calm is borrowing from. And if you study the current market with respect, rather than with comforting denial, you come to a very sober conclusion. The market has not stayed elevated because the danger was imaginary. It has stayed elevated because the support beams were stronger, more expensive, and more deceptive than many people first understood. That is the lesson, not that collapse is guaranteed tomorrow, not that doom is a hobby. The lesson is that delay is not the same thing as safety. Delay often means the risk is still growing in places the crowd does not want to examine. That is why I am not reassured by the market's refusal to break. I am made more cautious by it because once confidence goes, the people who took delay as proof usually lose two things in the same season. First, they lose the illusion. Then they lose the price. I would rather surrender the illusion early and keep the clarity. That, in my experience, is the wiser bargain. There is another reason I begin with valuation. Valuation is one of the few places where mood is forced to touch arithmetic. People can tell themselves stories about artificial intelligence, productivity, resilience, or policy support. Fine. But eventually the question becomes how much current and future reality is already being paid for in today's price. When the price has already absorbed too much hope, the investor is no longer buying a business. He is buying the perfection of a story. That is a dangerous trade. The danger grows when people confuse postponement with proof. If an overvalued market survives for a while, investors start treating survival as vindication. They say perhaps the multiple was justified. Perhaps this time is different. Perhaps the economy is stronger than the doubters thought. What they usually fail to consider is the possibility that temporary support simply extended the life of an expensive illusion. That is what I think has happened here. The deficit support kept liquidity moving. Inflation kept nominal earnings looking respectable. Consumers kept spending longer than their balance sheets deserved. The labor market stayed late enough to preserve the appearance of strength. and policy faith stayed alive because previous cycles trained investors to expect rescue. That combination can hold markets up. It cannot convert bad arithmetic into good arithmetic forever. This is why I place so much weight on the phrase delayed correction. Delay feels pleasant to the crowd. It is often most valuable to the cautious observer as a warning. A delayed correction means leverage keeps gathering. It means the public keeps buying the dip with growing confidence. It means positioning becomes more one-sided. It means the eventual shock lands on a larger field of complacency. That is why a later break is so often worse than an earlier one. An earlier break would have removed some excess before the excess had time to harden into belief. The public usually hates hearing that. The public would much rather imagine that if the market has tolerated too much already, then maybe tolerance itself is now the new equilibrium. I have no interest in that kind of wishful thinking. The bridge analogy matters precisely because bridges can look calm right until the moment they do not. Confidence behaves the same way. Confidence lets weak structures live beyond what frightened people think is possible. Then one event arrives in a context where confidence is too thin to carry one more shock, and all the false calm vanishes at once. This is where most investors fail psychologically. They think they are preparing for bad news. What they are really unprepared for is the speed with which confidence can change once the final support is questioned. That is why I prefer sobriety to prediction. Prediction flatters the ego. Sobriety protects the balance sheet. The sober investor studies quality, liquidity, and dependence. He asks what parts of the current market require continuing faith in expensive supports. He asks how much of current pricing depends on conditions that are not genuinely durable. He asks what happens if consumers weaken, if credit tightens, if earnings disappoint without inflation being enough to hide the weakness, or if policymakers cannot deliver the sort of rescue the crowd still assumes. Those questions do not make a man dramatic. They make him prepared. That is what I care about. Not being exciting, not sounding prophetic, being prepared. Because when the break finally comes, the crowd will say it was sudden. It will not be sudden. It will simply be the moment the supports stop hiding the arithmetic. There is also a moral temptation investors should resist in moments like this, when prices keep rising against weak fundamentals. People begin to think valuation discipline itself was naive. They start mocking caution, as if caution were a failure to understand the new era. I have seen that movie too many times. The late stage of overvaluation always makes discipline look old-fashioned, right before discipline becomes essential again. That is why I do not want to be the man who joins the euphoria, because the euphoria has survived longer than expected. I would rather be the man who respects the cost of delay and keeps asking what that delay is borrowing from. That habit of mind matters more than a heroic call on the exact date. And if you keep that habit, you do not need to panic. You only need to remember that markets held up by expensive supports do not become safe because the crowd got used to them. They become more dangerous. That is the lesson I would rather keep early than learn late.